Hello and welcome. If you've ever wondered how professional investors pick their stocks or how they assess the health of a company before making investment decisions, this video is for you. Today, we'll be diving deep into fundamental analysis, one of the most powerful tools used to evaluate companies and determine their true worth. This video valuable information that you can apply in your own investing journey. Whether you're just starting or you've been in the game for years, briefly introduce Benjamin Graham as the father of value investing and how his approach to fundamental analysis changed the way people view stocks. Why fundamental analysis matters. Before we jump into the technicalities, let's talk about why fundamental analysis is so important. Fundamentally analyzing a company is like performing a health checkup before making any decisions. By studying its financial statements, you get a clearer picture of its financial stability, profitability, and growth potential. This is not about chasing trends or following market sentiment. It's about finding companies that are undervalued relative to their intrinsic worth. If you can identify those opportunities, you set yourself up for long-term success. What is fundamental analysis? Defining fundamental analysis. Explain the concept. Fundamental analysis is the process of evaluating a company's financial health, its industry standing, and its future prospects by studying various financial statements, such as balance sheets, income statements, and cash flow statements. Introduce the two main types of analysis: quantitative analysis, which focuses on numbers, and qualitative analysis, which looks at factors like management, competitive advantages, and market conditions. The role of financial statements. Balance sheet. The balance sheet is like a snapshot of a company's financial position at a specific point in time. It shows what the company owns, assets, and what it owes, liabilities. The difference between the two is the company's equity or net worth. Walk through the components of a balance sheet: assets, liabilities, and shareholder equity. Income statement. The income statement is the report card of a company's profitability. It shows how much money the company made and spent over a given period, usually a quarter or a year. Explain the key metrics on the income statement: revenue, cost of goods sold (COGS), gross profit, operating income, and net income. Cash flow statement. The cash flow statement reveals how cash moves in and out of the business. Unlike the income statement, which uses accrual accounting, the cash flow statement focuses on real cash. Explain the importance of operating, investing, and financing cash flows. The purpose of fundamental analysis. Explain the goal. The main purpose of fundamental analysis is to determine the intrinsic value of a company. By doing so, you can assess whether the stock is overvalued, undervalued, or fairly valued. Provide an analogy. Think of it like buying a house. You look at the house's price, its condition, its location, and compare that to other houses in the neighborhood. If the house is priced too high relative to its condition and location, you might avoid it. But if it's priced below market value, it could be a great deal. Key components of fundamental analysis. Discuss earnings, revenue, debt, growth rate, and profit margins as the key components analyzed. Introduce valuation metrics: price to earnings, price to book, dividend yield, etc. Mention economic factors: how macroeconomic factors such as interest rates, inflation, and GDP growth impact fundamental analysis. How to analyze a company using fundamental analysis. Step-by-step guide to reading financial statements. Walk the viewer through a real-world company's balance sheet, income statement, and cash flow statement. Explain each line item in detail and how it ties back to assessing the company's health. Example: walk through a real company, for example, Apple or Coca-Cola, and explain their financials for the past year. Key ratios for fundamental analysis. Discuss the most important ratios investors use for financial analysis: liquidity ratios, current ratio, quick ratio, profitability ratios, gross margin, operating margin, net profit margin, leverage ratios, debt to equity, debt ratio, efficiency ratios, return on assets, return on equity, asset turnover. Walk through how to calculate each ratio and what it reveals about the company. Show how to apply these ratios to assess whether a company is a good investment. Understanding earnings reports and forecasts. Earnings reports show how well a company is performing and whether it's meeting or exceeding analysts' expectations. Explain terms like EPS, earnings per share, revenue growth, guidance, and how they influence stock prices. Valuation techniques in fundamental analysis. Price-to-earnings ratio. Explain the P/E ratio. The P/E ratio is one of the most widely used valuation metrics. It compares a company's stock price to its earnings per share. Apps discuss how to interpret a high or low P/E ratio. Example: walk through a real example of how the P/E ratio works with a current company's data. Discounted cash flow analysis. Introduce DCF. Discounted cash flow is one of the most powerful tools for determining a company's intrinsic value. It involves projecting the company's future cash flows and discounting them back to their present value. Step-by-step guide on how to perform a DCF calculation. Project future cash flows. Choose a discount rate. Calculate the present value of future cash flows. Example: walk through a DCF calculation with a company like Amazon. Price-to-book ratio and other valuation metrics. Discuss the P/B ratio. The P/B ratio compares a company's market value to its book value. A ratio below 1.0 suggests the stock is undervalued. Mention other ratios like price-to-sales, P/S, and dividend yield and how they can be used to find undervalued stocks. Applying fundamental analysis in real-life. Case study 1. Apple Inc. Walk through Apple's financial statements and ratios from the previous year. Use fundamental analysis to assess if Apple is a good investment at its current price. Discuss Apple's growth potential, debt load, and cash flow generation. Case study 2. A troubled company. Choose a company that has struggled or faced major financial challenges, for example, a company affected by the 2008 financial crisis. Walk through its financials, identify red flags, and explain how fundamental analysis reveals the risks involved. Discuss what went wrong and how fundamental analysis could have warned investors. Advanced concepts in fundamental analysis. Macro factors impacting fundamental analysis. Discuss how macroeconomic factors like interest rates, inflation, and market conditions can affect a company's performance and valuation. Example: how does a change in interest rates affect companies with heavy debt loads? Sector and industry analysis. Explain how to analyze a company's industry and sector. Not all industries are created equal. Understanding the competitive dynamics and challenges specific to an industry is crucial. Example: compare a technology company's fundamentals to a utility company's fundamentals and how sector differences impact valuation. Qualitative analysis. Discuss the importance of qualitative factors such as management quality, brand strength, competitive advantages, and market position. Explain how these intangible factors can be just as important as the financials when analyzing a company. Final thoughts and conclusions. Summarize the core points. Fundamental analysis is about digging deep into a company's financials to understand its true value. By analyzing its financial statements, key ratios, and growth prospects, you can make more informed investment decisions. Reiterate the importance of using a combination of qualitative and quantitative analysis. Encouraging further learning. Encourage viewers to dive deeper into specific metrics, tools, and techniques. Mention that fundamental analysis is an ongoing learning process. The more you practice, the better you'll become at spotting good investments. If you found this video helpful and insightful, be sure to give it a thumbs up. It helps support the channel and lets me know that you enjoy this type of content. Don't forget to subscribe and hit the bell icon so you don't miss out on future videos, where we'll continue to dive into more investing strategies, tips, and financial insights to help you grow your wealth the smart way. I truly appreciate you taking the time to watch and learn with me today. Remember, the journey of investing is a marathon, not a sprint. Keep practicing your fundamental analysis skills and you'll see the rewards over time. Thank you once again for being part of this community. Keep learning, stay disciplined, and I'll see you in the next video.